So here we go, the 6 stocks I'm buying, January 2025 edition. This is where I go through all the stocks that I've been buying from the 1st of December to the 1st of January. So any stocks that I bought are going to be on this video here today. The reason why I do it is it keeps up that transparency, so you know what I'm buying, you know what I'm selling. If I sold anything, it'll also be in this video, and there was 4 stocks that I sold. Well, there was one that I completely sold out of, and then 3 positions I trimmed, and that'll also be on the video today. And like I said, I've done this video series for many years on the YouTube channel. It just keeps up the transparency, so you guys know the moves that I'm making in the market. Anything that's happened in the portfolio, buying or selling, always comes on this video series every month. It's probably why it's probably the most popular video series that I do, so you can see what I'm actually doing in the market right now. So I hope you enjoyed the video. Hit the like button, subscribe if you're new around here. Let's get started. So just before we do start, if you do want to join the Patreon, the link is in the description. £5 a month, 2 exclusive videos a week on there, and you get to know what I'm buying and selling in real time on there. It is the last 24 hours before the prices do go up. So on Monday, the prices are going to go up by 20%. So if you do want to get the cheaper rate, now is the time to do it. So you could get that cheaper fee. After that, obviously, the prices will be 20% higher than where they are currently right now, and you can lock in at that cheaper rate. And as well as that, you support the YouTube channel. If you do want to start investing, link in the description to join Trading 2. That's personally the investing platform that I use. You join for that link, you can get a free fractional share worth up to £100. A lot of you guys have been using that link at the moment. Let's go on to stock number 1. So the number 1 stock is Google. Google is a big position for me. I believe it's my 5th largest position, behind DraftKings, Hims and Hers, PayPal, which we'll actually get onto PayPal a little bit later on in this video, and Meta. So it's a position I really like. It's a position that I always get a little bit frustrated with, because I actually should have this as a larger position. This should be a top 3 holding in my portfolio. It probably should be my number 1 position in the portfolio. The only issue why it's not there is it just didn't stay long enough during this period of time, so I wasn't able to get it built up that quickly. I've kind of got to the point now though, even though the stock has rallied up massively since that point, I'm kind of like, I still want it to be a top 3 holding, maybe even my biggest holding. So I'm kind of like, if it does have some little drops, I will add into those drops, especially like a 20% drop, I will add into it. And even if it doesn't have those 20% drops, I'll still add into it a little bit every month and try and build up that position up in Google. So if it drops more, that's where I'll go a little bit aggressive. If it doesn't drop, I'll still do small adds into the position just to kind of keep building it up, because I think it's a very big position that it's a position I would like to be a very big position in my portfolio, because I really do like Google. Now, one thing to kind of look at with Google is sometimes you forget how much they own. You know, obviously you just automatically think the Google search engine, and then you kind of break it down to like all the services they do offer, and it's a big list of services. Right now, one that's easy to forget about, YouTube. You know, you're probably watching this video right now on YouTube, unless you're watching the smaller clips on TikTok. They own so many products, and they are able to just keep, because they have such a good balance sheet, good amounts of profitability, they're able to make these smaller acquisitions or even invest into, you know, they can throw money in these products, and if they don't end up being anything major, it's okay, it's nothing for them, because of the amount of profit they generate, they can afford to kind of do these smaller attempts into expanding the business. Now, one of the things that kind of been selling it off recently, and especially during the dip, during this little dip here, as you can see here, there was a lot of news around the DOJ, and that they would end to look or try and break up the monopoly that Google have. Now, this might end up being somewhere, we don't know, but we are realistically not going to find out for many years. There's a lot of going back and forth about what eventually Google will do to kind of slow down the monopoly. But what Google has is what we've just shown before, is that if there was something to ever kind of happen to Google, they've got so many projects going on here that it would actually be okay for them if they did have something that was lost or taken away from them. But even then, there's a lot of back and forth, and in that time frame, I'm sure Google are going to create products that will make up for the loss of what is ever maybe taken away from them. One of the things is that is rumored about the payment to Apple to be the default search browser on Apple and the iPhones. Something like that, in my opinion, would actually maybe even help Google, because then they wouldn't have to pay Apple whatever the fee is for them to do that, which is some crazy amount of billion. They could even throw that into other products that they're kind of building here. The big thing around Google is that right now the company's trading around about 25 times earnings. You look at the valuation on a forward P, it's about 21 times earnings. So in 12 months time, we're going to be looking at Google around 21 times earnings. If you look at the S&P right now, I think the S&P is like 29, 30 times earnings right now. You shouldn't be in this point of view where Google is cheaper than the market. Google, in my opinion, is probably one of the top 3 best companies on the whole of the stock market, and yet it's cheaper than the market. That shouldn't happen with Google, especially when you look at the recent earnings as well. The recent earnings were absolutely fantastic. This is one of the strongest numbers I've seen Google do for a while. If you look at the Q3 numbers, they increased the revenue by 15% or 16% in constant currency basis. That's absolutely amazing. Google Cloud is growing rapidly. That's growing at 35%. That's increasing the profit by big margins, because Google Cloud is a very profitable is a profitable area that they could grow in. And that's what's dragging the profit up. So when you look at the profit, right now, total operating income was up 34%. Net income 34%, and EPS increased by 37% with some of the share buybacks as well they're able to throw off because they're so profitable. So this company is at the moment growing at very good rates, not even just kind of high single digit, 15-16%. Google Cloud is a major growth driver for them for many years. And then you just have all these other bets with them, like Waymo. This isn't even something I take into a big consideration when buying Google, but there's always this kind of thing about Tesla, and if Tesla's going to do, how's self-driving going to do for them? That's the reason why the market cap there is that people believe the self-driving will kick on for them. You look at Uber, people talk about Uber. I can buy all that with Google, and then I get I get all of those businesses here where I don't have to worry if they're going to be successful in self-driving. But what I'd say right now is you look at Google, and right now I'd say they're probably one of the companies that are ahead of the pack at the moment, and yet you don't even have to consider if it's successful or not with Google, because it's kind of like just an extra bet that you get free with Google, which I really like. And they're able to do this because compare it to Tesla and the likes of Uber, for example. You look at the company here. When you're throwing off about 100 billion of profit a year, you can do that. You can just chuck money into something and try it just because you can. You can throw it into the share buybacks. You can throw it into the dividend that they now pay as well. And it just keeps going up. 109 billion, imagine the amount of companies worldwide that Google are able to pay, could go by with 109 million. It's just, crazy money when you look at it from that point of view. And that's obviously why Google have one of the best balance sheets in the world, probably if not the best balance sheet in the world. It sits on around 4% debt to equity. You look at the cash pile, they're sitting on 93 billion of cash. That gives them so many options to kind of what they ever want to do with that cash. And I look at Google, and ultimately I just go back to the point of this is one of the best companies in the world, if not the best company in the world, and you're buying it lower than the market valuation, the average market valuation. That shouldn't happen. Google should be trading to a premium of the S&P 500. Now, you could argue the case that maybe the S&P 500 is a little bit overvalued, but there still shouldn't be that gap between Google. If Google's at 21 times earnings, you're paying the average valuation, around about 20 times earnings for Google. It shouldn't happen. Google's a company, in my opinion, that should be 30 times earnings. So yeah, I really still, even though I'd like it a little bit cheaper, I still can't argue too much with the valuation here. Number 2. Evolution, or Evolution, depending where you're from. Evolution AB, I do buy the over-the-counter markets on Trading 212 for you guys that ask me. I don't buy it on the STO. Just so you're aware of that, I always get a question around the ticker symbol. Obviously, us guys on the Discord have a good running joke about that one. But yeah, this stock, it looks like it's not really had a good kind of few years. Really, since 2021, the stock kind of peaked. It's been flatlining, but the last kind of couple of months, it's even fallen nearly 50% down. And especially in 2024, it had a pretty poor year, down 29%. So the stock hasn't really done anything now for kind of 3 or 4 years, and the last couple of years haven't been great for it. Historically, pretty good performer though. If you look at the all-time, obviously the stock is up 4,500%, which is being very good. But the kind of stalling in the share price, in my opinion, and the financials have continued to be absolutely amazing, means that the stock and the financials are disconnected. The stock price should be a lot higher from how good these financials have been, in my opinion. 13 times earnings, we'll get onto that in a second, and let's call it 3.7% dividend yield as well. So for you dividend investors, you're getting a lovely dividend as well with this one. Let's just look at what they do for a second. So they do a lot of iGaming products. So for example, they have clients like DraftKings and FanDuel, William Hill. And if you were to go on the iGaming on those sites, and you were going to go on the live casinos and live games shows, or the slots on there, they don't, like the likes of FanDuel and DraftKings, William Hill, Bet365, they don't actually do the games. They're all kind of focused on the product. They're kind of focused on the odds. That they kind of don't want to focus on all the games, and they can't give the time and the effort that they would need to have very good games. So what a lot of them do is they outsource it. They go to someone like an Evolution, go, can we have your live casino games where there's someone in a studio, they're doing all the kind of dealing, and they supply it to them and they get to put all the branding on it. That's what Evolution do, and then they kind of take a cut from the earnings that the likes of William Hill would get. So they've got a big client base, and obviously they kind of help a lot of these kind of players out. Now, as we know, that means these picks and shovel play, the likes of DraftKings, FanDuel, William Hill, Bet365, they all have big drivers at the moment. You know, the UK has been a market that has been very good for them, but we've seen a lot of other countries starting to do a lot of iGaming. So the likes of the US only about 7-8 years ago didn't allow iGaming. It's now starting to allow iGaming. And what they get to do is all these states are getting to make all this tax from the iGaming. And slowly, more and more states are coming online. Recently, it's been a little bit slower coming online, and that's maybe something that has slowed the growth rates down a little bit, but it's still been very good. That's me trying to find a negative there. You can see here in 2023 to 2024, US iGaming was forecast to be growing at 22%. By 2027, the US iGaming market is forecast to be worth 10 billion to 13 billion, and the US becomes the largest iGaming market, so there's big growth drivers there. You have the likes of Brazil. Brazil is going to also start allowing iGaming, and there's plenty of other countries as well that have big growth drivers. China, we're not even mentioning China, that's a big growth driver for them as well. And what you really get this company right now is down at 11 times forward earnings. So that is very low. But yet when you look at, let's go to that slide actually first. But when you look at the recent financials, they've been amazing. You know, 11 times earnings. And if we go on the recent Q3 update, operating net revenue increased 27%. EBITDA increased by 30%. So there's no kind of issue with the financials. In fact, when Evolution brought out these financials, the stock actually, I wonder if I can you see it here? There was a little bit of a pop-up. The stock jumped up 14% when these financials came out. And then in the weeks following, the market just went, actually, we're going to give it all back, and then we're going to go lower. So even though they brought these financials out that were absolutely amazing, the market still just went, no, we're not bothered. And then sold the stock down another 10% since this update came out. When it first came out, the market was like, yeah, we're really happy. And then it kind of went, no, we're not actually happy. And right now, like I said, you know, you're getting a 3.7% dividend yield. You're getting a company that's 13 times earnings or 11 times forward earnings. The recent earnings were fantastic. You know, 27% revenue growth. You think the only thing I have with this stock is I don't understand why it's these sort of levels. I just don't understand it. I would generally make this probably my largest position if I didn't already have DraftKings as a large position. That's the only concern that I have, and I don't want to expose you to this market. But I just look at it, the valuations, the numbers they're doing just don't make sense. And I just think, does the market know something we don't? That's the only thing that I can see about why this stock just keeps going lower and lower and lower. That's the only thing I can see really with it. I look, and obviously the risk is maybe a client leaves them, but we've just seen probably one of the most important clients, FanDuel Casino, have just extended the partnership for another 3 years. So that's a good sign if they're kind of doing that. There's a few people trying to make a big news story out of what came out here on the 23rd of December that Evolution is under scrutiny in the UK because basically it gave its games out to a UK operator that didn't have a license. People saying that's a big issue. Well, it's not really. I think realistically they'll probably get a slap on the hand and they'll probably get a little bit of a fine. People saying, oh, well, they'll get the license taken off them. I mean, that's a worst case scenario. If they had the license taken off them, at the end of the day, the UK makes up 3% of the revenue, I believe it is. So it's going to be a little blip, which just, yeah, I'm absolutely fine with that. You look at the growth of the company, it looks like it's only going to continue from analyst expectations and from my expectations as well, that iGaming growth. Very good growth, good amounts of profitability, as you can see here. As you expect with that sort of profitability, you know, absolutely cracking balance sheet, as you can see here. Ownership-wise, there hasn't really been any activity and some sort of weird thing going on here at the moment, but the CEO did buy some shares not too long ago. So yeah, I do like Evolution at the moment. Number 3, Celsius. So I originally started buying Celsius during the 2022 stock market crash. Sold out of it, made some good money. I thought maybe I'd gone a little bit too early on Celsius. Turned out it was actually an okay move in the end. And then I actually started buying back into the stock. And when I started buying back into the stock after it started crashing, I thought, okay, this is a good level. But Celsius has continued to go a little bit lower from even when I bought it. So I am down around about 20% on my Celsius position, but I'm okay with that because I still think Celsius will do quite well from where I have my average at the moment. Celsius, energy drink provider. You probably see them in the US. If you go to the US, they're everywhere in the US. Expanding though internationally in the UK as well. In the UK, we do see them in Tesco as well. Celsius, I think, is a very good energy drink. In fact, I would say it's my favourite energy drink. I would buy this a lot more often if it was a lot more available in the UK. Unfortunately, because it's only in Tesco and I believe WH Smith, it's quite hard to source it. So if you go to your local petrol station, you probably won't see it too much, unless you can get it on Amazon as well. But as they expand more and more, I think they'll do quite well. The tastes on them are good. The UK flavours could be slightly better, but some of the US flavours are particularly very good. There's, as well as that, good sizing. I think as well, it's a little bit more healthier. You don't get that big rush, so you get that high sometimes with energy drinks and then you sink afterwards. I don't really see that with Celsius when I've had them before, whether that be in the UK or the US. Very popular with teens. They're growing big market share in the teens at the moment. The teens prefer it over the likes of Red Bull and Monster, so it's overtaken Red Bull on Amazon and it's quite close to overtaking Monster on Amazon as well. And teens love it more and more. It's a favourite energy drink, and as you see before, if you're popular with teens, it normally spreads to the other age categories as well. Now, one of the big things why the stock has struggled is because of Pepsi. Pepsi bought a stake inside the business. Now, normally you'd go, oh, well, Pepsi buying a stake is a good sign. Pepsi are kind of thinking, this looks really good, we're going to buy a stake in it. You'd normally be happy about that. But what also happened is Pepsi took over a lot of the distribution of Celsius. And they said, we don't want to affect the supply chain. So what happened is Pepsi ordered a ton of the cans. They then realised we've probably ordered too much. And then because they ordered too much, they've not been ordering any more to clear the inventory out. Now, because Celsius counts the sale when they kind of give it to Pepsi, now Pepsi have kind of slowed down the sales a little bit. They're kind of like, well, our sales are struggling at the moment, and that's what's made Celsius numbers not look great at the moment. An example of that is if you look at the revenue growth. So you can kind of see where the Pepsi deal kind of got signed. There was a kind of speed up in orders, and then you can kind of see the slowdown. And at the moment, they're kind of working through this backlog of inventory that Pepsi have. They're saying at the moment that Q4, or what has been Q4, so obviously we're past it now, was going to be the last quarter where Pepsi are working through this inventory, and it should return to normal after that, which would be great. Because if we do look past the issue with Pepsi and the numbers that Celsius actually can see, so sales in the retail are still increasing 7.1% year over year. If you look at Amazon sales, they're still increasing 21% year over year. Costco, that was up 15%. So when you look at past the inventory issue with Pepsi and actually looking at this, the point of sales, they're still increasing rapidly at the moment, which is really good to see. And you can see the speed up of revenue, so we're still expecting a bit of a slower quarter in Q4, but next quarter we can see we start moving back up in the right direction. And from the slowdown that we had in 2024, it's forecast to start speeding up again in 2025. And if they start doing these numbers that are expected, I think if you run Celsius growing 15% a year going forward, I think the stock will obviously do quite well. And then obviously the little benefit you might have as well is if the expansions kick on. They seem to be doing really well in Canada at the moment. UK so-so. I think they could do a few things a little bit better in the UK. I have actually asked the management team before that I could give them a few pointers. Unfortunately, they denied that. Ireland as well, which I think maybe they can do a little bit better because the audiences in the UK and Ireland are very different to the US and Canada. So we'll see how them two go. I don't know how well they'll do, but I do expect the Canadian market to be very good for them as well. And as we can see here, analysts are expecting that recovery to start happening, which would be really good to see. If they do these numbers, I think the stock will do very well. Financial health-wise, yeah, pretty good balance sheet. You can see here, no debt on the balance sheet. Cash-wise, got around about 903 million of cash. My only criticism of Celsius is because the stock price is so sunk at the moment. If I were them, I would be throwing about, they're going to make decent amounts of profitability as well. If we do just jump back to the profitability, they're going to be making about 163 million-ish a year. The end of this year, actually, they expect to do 226 million. I don't know why they just don't throw a 400 million into a share buyback right now. That's the only criticism I have of the management team. Apart from that, yeah, I do really like Celsius. Next one, MercadoLibre. So MercadoLibre, Latin America, e-commerce, fintech company. A stock I've owned for a while. It's one of my larger positions in the portfolio. Started buying in 2022 around about $706. Since then, the stock is up 148%. Personally, for me though, I just keep buying. Every so often, this stock has a couple of dips. You can see here, around about a 21% dip. There, you had about an 18% dip. Feb 2024, you're having a 20% dip there. And right now, we're currently going on around about a 14% dip. So every so often, this stock has like a 10-20% dip every so often. But if you look at the longer term, yeah, the company's absolutely been on fire. And I just keep adding on those dips. I think this company is a very good company for the next 10 years. It's one of the ones that I find quite secure because I look at MercadoLibre, obviously e-commerce. They are the Amazon of Latin America, basically. Amazon were very slow to expand into Latin America. MercadoLibre filled the gap, and now Amazon have kind of given up on it, and MercadoLibre are doing what Amazon do. They built the fulfillment centers and they're taking a lot of market share in Latin America. So Latin America is about 10 years behind us in like the likes of the UK and US. So you think about where we were 10 years ago. Is it only going to get bigger? 100%. More people are going to start ordering more online, and that especially happened after the CV times. They also own Mercado Pago. They started a payment method for the online as well. There wasn't many online banking in Latin America a few years ago, so they created Mercado Pago, and this has done very well for them and has enabled people to go buy their products online. But people are also using Mercado Pago as well for other things and shopping on other sites as well. And if you look at the growth of the Latin America e-commerce, you can see here this is going to grow at 14.3% and is one of the fastest growing e-commerce countries out there right now. It's the same for the sort of payments as well. If you look at the recent earnings, the market didn't like it. I liked it. I think the main reason why is the market threw its toys out of the pram because MercadoLibre put a little bit more investment in this quarter to kind of take more market share in 2-3 years time. The market's short-term thinking and went, we don't like that because it hurt your profitability. For me, I'm like, okay, I like that. You're investing for the long term. It's going to create more revenue and profit further down the line. The market does that. The market thinks 12 months out. As me as a long-term investor, I'm thinking 3, 4, 5 years out. And that's what I like about that investment. Net revenue is up 35%. Obviously, something to be careful of is the FX impact sometimes because they are converting from some of these currencies into US dollars. So without the FX impact, this actually grew at 103%, but because of the FX impact, 35%. So they are able to grow some of these outgrows from these FX impacts. Income as well, nice at 457 million. Total payment volume up 34%, 73% on an FX neutral basis, and gross merchandise, so the e-commerce up 14%. And 71% on an FX neutral basis. So yeah, just be careful of those FX impacts every so often. If they were able to stabilize a little bit more, the growth rates would look absolutely crazy. And yeah, right now, 39 times forward earnings. I think that's very good for the company that's doing these numbers that MercadoLibre are doing. Normally, this company trades at some at 60, 70, 80 times earnings, depending on where the market puts it at. So you're getting, if they hit the numbers they should do in the next 12 months, you'll, in my opinion, yeah, you'll see another double up in the share price as long as the FX impact isn't too big, because that is the concern at the moment, and that is why the stock has been selling off recently. Longer term, I don't really worry too much about a lot of these currency impacts, and they will stabilize. And when you look at MercadoLibre, if they do the numbers that they're supposed to do, with the track record they're supposed to do, yeah, I think it'll do very well. And that leads me on to another Latin America company, which is New Holdings. So a bit similar to what I just talked about with MercadoLibre and Mercado Pago, New Holdings is once again a online banking company. The only difference between MercadoLibre and New Holdings is obviously the online banking only, but New Holdings only operate in a smaller amount of companies, where MercadoLibre is more broad. So as I just said there, the big thing is the currency risks, the Brazilian currency in particular, concerns around that at the moment, and that's why the likes of MercadoLibre are going down. That's the reasons why New Holdings is going down at the moment, and you can see that's caused around about a 30% dip in the share price at the moment in New Holdings. Now, if you look at it, it's about the same as where it IPO'd at around about 4 years ago. Not that that's a big kind of point to go, oh, look, it's cheap, but I do think it's cheap when I do start showing you some of the numbers with it. So you can see here in Brazil, 36% of adults have a new bank, and you can see it is the #1 platform in Brazil. They did launch Brazil around about 2014. Monthly active users are growing massively. They did just launch in Mexico just before COVID, and also Colombia in 2020, as you can see here. So you could say that they are a little bit more risky because they only have a few countries they do operate in. At the same time, you could say that New Holdings potentially has the potential to gain bigger market share because they have the potential to go into likes of Chile and Argentina, for example. So yeah, look at that how you will. I look at it as a positive that they could potentially expand into other areas. And as well as that, when you look at the cohorts are still growing rapidly in New Holdings. So if you look at like the likes of the 2019 and earlier cohort, still growing at 31%, sorry, not 31%, 51%, which is very impressive. So the users that come on don't just start using Nubank, they end up using Nubank more and more, and they're still growing, which is really good to see. Last year numbers, 47% revenue growth, good jump in the EPS. 32% expected this year. Obviously, you know, a lot of that depends on the FX impacts. It is forecast a little bit of a slowdown here, but obviously if they do that number still, I think that'll be very good. When I do my numbers, I actually have it even more cautious than what analysts are expecting, and I still see big upside, which gives me that little leeway there. All this at a forward P of 18 times earnings, I think that's very much worth the risk with the currency impacts, in my opinion. So yeah, I do like New Holdings, and I am buying it up at the moment. I've got a full video that I did a few days ago on this one if you want a bit more information. Same for this one, AMD. I have got a full video that I did about a week ago on AMD. If you do want a little bit more detail, I'll keep it nice and brief for you guys that have seen it, because otherwise you'd probably like, Jacob, I've just seen a full video on this that's like 20-30 minutes long about a week ago. So I'll keep it nice and brief, but yeah, I am buying AMD. This is like New Holdings, that's a brand new position. AMD is a new position into the portfolio. All time, done very well, great performer. Lisa Su, CEO, came in 2014, turned the company around, took big market share off Intel, and since then the stock has performed absolutely amazing, up 6,000%. And I'm sure Lisa Su is going to once again get the company firing, and the stock will do very well. Last 5 years, up 140%, even on the big pullback it's had since 2024, down 42% since that time frame. So even though AMD kind of is in the sort of same space as Nvidia, a lot of people thought AMD would be a big winner in the AI space. That hasn't happened. It has fallen a little bit behind Nvidia, and at first people thought, no, it'll be okay, and then people kind of went, actually, no, it's not, and sold it off. But what AMD is starting to do now is they are starting to catch up to the likes of Nvidia. And if you want more information, like I said, you can go watch this video that I did 6 days ago on AMD. They've got 4 sectors. The big thing is the data center. This is where the big growth in the AI is going to potentially come in the next kind of few years. They are bringing out the new products like the MI325X, which is going to start production in this quarter right now, and there's other products coming out at the moment, which is the 400, I believe it is, which is the MI355X, which is also coming in the GPUs in 2026. So it looks like some of these products are actually starting to catch up a little bit to where Nvidia is. Data center wise is the biggest contributor of revenue here, obviously the big boom in the AI as well. Eventually other players will need to come into this space. Nvidia cannot be the only player, they cannot handle the demand, and also people will eventually come price competitive. If Nvidia thinks they can get away with it and charge whatever they want, people are going to be like, we want another competitor in here so where we can have cheaper rates, and that's why it's important for AMD and other competitors that will be looking at someone like an AMD to kind of catch up. Revenue wise, the data centers up 122%, which shows you the growth is coming back, the orders are coming back. And as well as that, it's the highest margin margin part of the business. So that's why the profitability is really starting to ramp up on it. And as we go Q after Q, the numbers are starting to improve now. We're expecting 22% in Q4. That's going to be a good improvement in the EPS. By March time, once again, up to 28% growth as well. And EPS wise, a good improvement again. This year, from where we were in 2024, you can see there's going to be the speed up of revenues, and from an EPS point of view, we're expected to go from $3.33 up to $5.13. Obviously, that will be really good if they're able to do that. And when you look at the valuation overall, you pick this company up right now at 23 forward times earnings, which I think is very much, even though there's a few risks here with this sector goes in cycles, it's also a bit more of a complicated sector. I think when you're paying 23 forward times earnings, I think there's a good amount of risk to reward here for investing. And that leads me on to the sells. So those are all the stocks that I bought, the 6 stocks that I bought. This takes me on to the sells. 3 stocks I trimmed and 1 position I sold out of completely. So I'll go through them all now. So first of all, PayPal. PayPal, I have continued to trim the position through the 1st of December to the 1st of January. I just keep trimming the position every so often. I think I trimmed the position for around about a 25% gain. I'm just trying to find my notebook. Yeah, 25% profit. So yeah, I'm slowly just selling parts of the business off in PayPal. It was my third largest holding. I want to reduce PayPal probably down to about my 7th or 8th largest holding. The reason why, I just look at the valuation now, 19 times earnings. The numbers haven't gone where I thought they would go, or what I was kind of hoping for. It's really slowed down. In Q4 we're expecting 3% revenue growth, which I just don't think is good enough. The numbers are for it to start speeding up slightly. Next year, 5% revenue growth. Overall though, like if you ever go back to my PayPal videos when I was buying it, ultimately my thoughts were that PayPal would grow at like 9-10% a year, and if it grows at 9 or 10% a year, then obviously what would happen is that they would be able to drag the profit up a little bit more, and that would lead to metric expansion where it trades more than 20 times earnings. Right now, I think if PayPal grows around about 5% a year, and I don't even know if they can do that yet, because obviously you've got to have some increase from where they are at right now, I think 20 times earnings is about fine. And then I look at where it's at, I think really PayPal has maybe 20-30% upside in the next 5 years. That's just not enough for me. So, and also as well as that, they've been struggling to really beat the numbers massively recently as well. They've been even missing numbers slightly. Just not good enough for a third largest position in my portfolio. So that's why I've kind of been selling that off, and I've been putting into other stocks that I see bigger opportunities in right now. As as you've just seen, the 6 stocks that I've been buying, the likes of Evolution, for example. So a little bit of profit and rebalance of the portfolio going on there. Next one, SoFi. So no reason that I kind of sold SoFi apart from just locking in profit. I sold around about 5% of my holding. I sold it for 145% return. So yeah, a stock that I started kind of building up as the stock kind of stayed in this range. Basically, didn't do anything for a year and a half, and that's also key why you've got to have patience sometime. I had to sit on SoFi for a year and a half without the stock doing anything. And I saw it in the comment section, the classic, oh, it's a trash stock. And next thing, it goes up 145%, and everyone goes very quiet on it. It's rinse and repeat. It's exactly the same what I'm kind of seeing with B&M right now. You can go the long list of stocks that you could see the exact same thing on, where people go and Hims and Hers, DraftKings, and MercadoLibre, Watches of Switzerland, Dark Trace. So often, I buy a stock and I can see the comment section just flooded with, oh, it's a trash stock, and it doesn't do anything for a year, and everyone goes, oh, it's trash stock, and then boom, it goes up 145%, and everyone goes very quiet. It's classic comment section sometimes. But yeah, SoFi I was buying quite heavy in that $6-7 range, and it just ran up. Obviously the last few months of the year, the stock went absolutely ballistic. I was up on my position like 145%, and it has had a little bit of a pullback recently, and I just thought I'm going to take a bit of profit off the table. And obviously it went from being undervalued to about fair valuation. And when sometimes these stocks go up in a straight line, they sometimes have a little bit of a pullback because it's better for a stock to go up nice and steady. And every so often, when a stock goes like this, eventually there's going to be a point where people go, I'm going to take a bit of profit off the table, and it has that knock-on effect, and it might end up giving a little bit of it back, and you'd be like, oh well, I wish I took some profit off the table when the stock was $16-17, and that's what I did really. And yeah, just had to lock in some profit, because that's why we do it. We're here to make money, and I had to make sure that I locked in some of that profit there. Next one, Ulta. Ulta is a position I've completely sold out of. Not a holding I've had for a very long time. I've only had it for about 6 months, really, if that. I sold it all. For 17% profit. Stock went a little bit ballistic when Warren Buffett kind of went in. The last earnings were decent, but then I started looking at the last earnings, and I thought there's still a lot of a way to go here for Ulta. The numbers have to, current year of 0% growth, next year 3% growth. Really, for them to do well from here, I expect the company to need to get back to 5-7% revenue growth for them to do that. I mean, if you look at the system, I think the forward P as well as 17 forward times earnings. So for the company to do any better from here, the numbers still have a big turnaround to go on. And the other thing is that I bought because I thought one of the growth drivers for them would be the Mexico expansion. I've not even heard that mentioned for a year now, which makes me a bit nervous. And I just thought, I've made a quick profit in 6 months. There's still a lot of improvements that need making here for the company to do well, I'm just going to take my profit and run. And I think I also put it into a new position, which was either AMD or New Holding. So there was also a connection that I just used the money as well for another opportunity. So that was Ulta. Lululemon I bought in summertime as well. This has done absolutely amazing for me. The stock is up a lot. As I said in summer, Lululemon is a far better buy than Nike, and obviously Nike has struggled massively since that time frame. In fact, it's just gone absolutely lower. So as there was some other YouTubers, financial education, were talking about buying Nike and saying that this is the best opportunity. No, it wasn't. It was Lululemon, and I was buying that, and it's obviously done really well. Still hold my position, but I just had to lock in some profit because of the run that it's been on. Sold about 10% of my holding, and I sold that for around about a 68% return, which obviously was really good. Still holding some of the stock though at the moment. As I've sold it, the stock has gone up a little bit more, I think, since I sold it during the December time. It's gone slightly higher. I just don't know where to go Lululemon now for the rest of the position, because it's 26 forward times earnings, so it's not dirt cheap anymore. When I was buying this, it fell all the way down to like 17 forward times earnings, which was just way too low. It was still, compared to Nike, it was still doing very well because the profit was going up, the revenue was still growing. It still had clear growth drivers with the likes of China, for example. So I was still, very happy to just keep buying and buying and buying. As we've kind of gone on, as the stock price has kind of increased now, the growth hasn't improved that much. It's 9% in 2025. Next year, 7% revenue growth. Nice little increase in profitability for sure, but I'm kind of looking now, and I did take some profit off the table, which was nice, and I'm just kind of weighing up now about how much more do I keep on holding it, or do I kind of like just take all my profit away now and run. Like I said before, the thing that makes me concerned about this sort of space is the fashion space, is that sometimes something is very popular and then all of a sudden it's thrown out of the fashion demand. People don't want it anymore, and you can go very quickly from a stock that's rising to a stock that absolutely falls off a cliff and nobody wants anymore. The likes of Under Armour come to mind, Boohoo for example. Very quickly someone like a Team Machine comes out and people don't care anymore. So there's not really any moats here. And I guess that's the only little thing that does make me a little bit nervous about where I go with the rest of that position now. But for now, just to make me feel a little bit better, I did lock some profit in anyway. So that is the 6 stocks I'm buying January 2025 edition, guys. Hope you enjoyed the video. If you made it all the way to the end, hit the like button. Make sure you subscribe if you are around here. And apart from that, I might see you on Monday. I'll think about it, or if I might give Monday a miss. We'll see what happens, because this video is a long one and it's going to take a long time to edit. But thanks if you didn't make it all the way to the end. And have a great Sunday. See you in a bit.